So today we're going to start a series on trading the trend or trading swing-based trades with OFA. We're looking here at an upswing that has started down around 8 a.m. trading up. And you can see our CWAP line in blue and the VWAP line in pink. I've set up a basic ATM strategy, and what we're going to do is just place an order right in front of
Order pending.
the CWAP. So you can see the CWAP is now lined up with my order. I want to get one tick in front of that. And we're just going to manage it this way until either it's filled or the trade runs away from us. And once the trade's filled, we're going to try and get our stop right behind the volume weighted average price. And the idea is that we should be able to capture a move higher by leading the volume weighted average price a little bit by using the CWAP. So the CWAP is similar to a VWAP, except that instead of looking at the weight based on every price move, we're looking only at the volume that traded within the volume clusters in each period. So from the bottom of our swing higher, we're taking all of the volume within the individual clusters, we're weighting it, and that's giving us a leading edge to the volume weighted average price. Now in a swing, if we're moving higher, we should stay above the average buying price, which is what the VWAP represents. So in a swing, we would look to get long in front of that and have the volume weighted average price sort of be our backstop. Once we've traded through the volume weighted average price, and of course in OFA we're never just looking at price alone, we're usually talking about volume as well, then we would assume the swing is effectively broken or the trend is broken, and we can start looking for either a counter move or a continuation of that move getting started all over again with a new point of origin. So we're just going to continue to move this order around and see if we can get filled on this upswing.
Order filled.
All right, so we've managed to get the trade filled, and the ATM strategy just goes out automatically. I believe I've got it maybe set to 12 tick stop, something like that, or 8 tick stop. But the volume weighted average price is not that many ticks away. So what I want to do is get my stop trailing right behind the volume weighted average price, and I need to be focused on where my targets are. So I have an ATM strategy that's automatically put targets out up above me. Ideally, what I want to do is have those targets be some sort of risk to reward ratio. So NinjaTrader has a neat little tool under drawing tools. It's called the risk to reward tool. And if you place it where your entry is and drag it down to where your stop is, it will tell you what the multiple, what price would be whatever multiple this is set to. So for example, let's click on this and you'll see that the risk to reward ratio right now is set to 2. Well, 2 to 1 is a good place to start. If you are making 2 to 1 on your trades, generally speaking, if you do the math, every time you put a trade on, if you're making 2 to 1 on it, then you really only have to be right a third of the time, 33 1/3%, in order to break even. So that's a good starting point for a place to take some profit that allows you to get very close to your entry and not have to turn every trade into a major move. However, we've got some other targets that are out there as well. Let me move this down just a little bit. And ideally, I'd like for those to come in let's say at 3 to 1 and 5 to 1. If I can get 5 to 1 out of a trade, I think that's a pretty phenomenal trade to take. And so what I'm going to do is just quickly go in and change these so that I can see where my 3 to 1 level is, and then I'm going to click it again and do it at 5. And I'll bring that one down as well. And now I've got my trade set up so that my first target, or half of my contracts, are going to come off at 2 to 1, and then 3 to 1 and 5 to 1. It's a good starting point for us. I'll go ahead and pull this line off so that that doesn't get in our way. And we'll see if we can get the trade to develop into the 2 to 1 level. Now again, I want to trail the volume weighted average price, which historically across the chart here is this pink line. In my profile, it's a little dashed line over here as well. And so anytime that moves up, I want to improve my stop. So I'm not just saying that, in this case, I believe it's 1, 2, 3, 4, 5, it's a 6-tick stop. I'm not just saying that I'm going to use a 6-tick stop on every trade. And I'm not just going to leave it there. So as hopefully the market moves up, my volume weighted average price should improve. Therefore, my stop should get smaller and smaller and smaller. So it's sort of like a trailing stop, except that it's not predicated on the fact that the market is going to move up a certain number of ticks and then my stop is going to move up a certain number of ticks. I'm letting the market dynamics, the volume, the average of where all trade in this swing has been placed, I'm allowing that to be the factor that tells me where to move my stop. Now that's what's so fantastic about OFA versus your typical systematic trade approach. This isn't 7 periods or 14 periods, or I don't even know how many it is, right? I don't have to sit there and count. I'm interested in what's happened since we started a downtrend and since we transferred from a downtrend into an uptrend. And I can't always have that be some fixed number looking back. So this allows me to capture the volume, all of the volume that's involved in this specific move. And once I've done that, that isolates where that volume weighted average price is for said move. So we're approaching that first target, 2 to 1.
Target filled.
And we've traded through it and filled the first target. Now our stop hasn't adjusted at all, but we're starting to move up, so hopefully the volume weighted average price will move with it. And we can see our second target, the 3 to 1, up above at 40.75. All right, so the volume weighted average price has moved up, so we're going to improve our stop, or turn it really into a trailing stop at this point, and we'll just continue to trail the volume weighted average price. We've now hit the 3 to 1 target. It didn't fill, but we tapped into it.
Target filled.
All right, and the 3 to 1's been filled as the market begins moving higher. Now our stop improves again, so we're going to slide the trailing stop up another tick. VWAP moving up again, will come in another tick. So now we have a 3-tick trailing stop from our initial entry. VWAP's moved up again, we're going to uptick again, and now just 2 ticks from our initial entry on the risk. Okay, so we're coming back down into the CWAP another time. You can see that we've actually come into it several times in the course of this upswing. And generally, we would expect that the market would hold against the CWAP, very close to it, at least above the volume weighted average price, and turn around and gain momentum again and head back up. And it appears that we've rotated off of the CWAP a little bit. Our volume weighted average price is now at our original entry, so staying a tick behind it really gives us just a tick of risk on the trade and just really on the final contract as well. So we'll see if this can continue to be propped up above the CWAP here and create another extension higher for the swing. And if not, we have very little risk on the table. And it looks like we're trading down
filled
in and through the volume weighted average price. And so this is an easy trade, probably the easiest trade to learn. This particular example is very simple, not a lot of complexity to it. We're looking at an upswing using one line as our entry, the other line as our stop. While this is a very simple concept, we find that what people really struggle with trying to learn this trade is the context. When do we know where to start a profile from? What makes for a good swing versus a bad swing? What other tools in the OFA tool set can help us maximize the trade? These are the things that we're going to be exploring in this video series. So I wanted to start with a very simple, basic example, and then we'll take it through many different steps so that you can really understand the pieces of this trade as well as many other trades. We'll do simple ones, we'll do complex ones, we'll do ones that fail, we'll do ones that you never should have gotten into in the first place. How do you recognize what creates a high-risk scenario? When does the risk to reward not make sense? When is it not justifiable? I mean, in this particular instance, we had a 6-tick initial stop. We took 2 contracts off at 12. So, already taking exactly what we were risking out of the market. We were risking 4 contracts at 6. That's 24 ticks. We took out of the market 2 contracts at 12 each. That's 24. So everything that on top of that was just gravy. We took all the risk off the table very quickly. So then to put another 18 ticks on the 3rd contract in the bank sets this up for a trade that can't fail, even if we don't make it to the 5-to-1 target, which is obviously, that would be our objective. That's what we want to see out of the market, but it's not necessarily what we're going to get. What I'd like to do is break this trade down for you in a little bit more simplistic manner. There are some great things on the screen here. Things like understanding the volume imbalances here and how this created an area of resistance, which was then passed through, and we can see the sequence, the print sequence alert here of passing through that. Things like this, as we get more advanced, are going to be great ways for you to not just rely on the volume weighted average price as your trailing stop, but to start to use things on the chart, volume levels on the chart, at which we really shouldn't be penetrating back through. So you don't simply have to use the volume weighted average price for your stop and just let it go. There'll be times where it just won't make sense because you'll see very clear levels on the chart that you shouldn't trade back through. And this is a good example of that. The other thing that we need to do is just put the trade in context. I was only showing you a little bit of the screen because I just wanted you to focus on how simple the trade can be. But in order to really get there, we're going to have to go in and start digging through why the market stopped here and why the market was likely to stop here. And once we can drill that down a little bit, these lessons should put everything in perspective for what you need to be doing as a trader to establish a swing trade opportunity and to justify the risk to reward. So what I'd like to do in these lessons is to sort of strip the chart down a little bit. I know we have a lot of neat tools and add-ons and features, and I've got some of them on my screen right now. But to begin, I think the best thing that we can do is really strip down the chart and just begin with the basics so that you can really understand the structure behind the trade. So what I'm going to do is go into the volume profile. I'm going to take some of the things off of the screen. I'm going to remove the bid and offer sequence alerts. Those are the little dots that tell us that something's going on in the print. And I'm also going to remove the imbalance circles. So we have the diagonal imbalance circles here, and you can see those have gone away as well. The other thing that I think is probably just more than we need to have on the chart right now is the delta histogram. So I'm going to take that off as well. Take that off at the bottom. That way nothing's getting covered up and we can really look at each individual period. Now what I've done is I've used a swing profile here, and really the only two lines that I'm using are the CWAP and the VWAP, and this is the historical VWAP for the swing. So I also want to go in and just clean up the profile so that throughout these lessons, until we get a little bit more advanced, we're not overwhelmed with the profile and all the different elements of the profile. While they come into play, it can also be very misleading. So I'll get a lot of questions from traders who are asking me about, well, there was the point of control was up too high, so why did you take this trade? And a lot of that has to do with the actual structure of the profile as opposed to just some fixed point. So I want to go into the profile settings, so just click on whatever profile you have, and we're going to pull up the volume profile settings. And what I want to do is just take some of this stuff off the chart. I'm going to remove the volume weighted average price. I'm going to remove the standard deviation lines. And I also want to go into the actual profile. And for now, I'm just going to get that off of the screen. So I'm showing right now the point of control and the value area. But what I'm going to do also is just remove the profile by changing the profile color to transparent. Now I'm going to click apply, and what that's going to do is that's going to save the swing profile, which is what I drew this with, to those defaults. So now anytime I draw a swing profile, it's just going to show me that little bit of information and nothing else. Just really looking at these two lines. Okay? And that will be very helpful in just sort of taking a very simple approach to this. I'm going to remove this profile. And I want to talk a little bit about why this trade makes sense, because now that we can see more on the chart, it really doesn't look like a big swing, does it? It just looks like we're stuck in a range. And that's what's interesting about the swing trade basis, is that you really don't need to be in a massive uptrend or a massive downtrend in order to utilize this tool. But we do have to set up some rules and some logical expectations for what makes sense, when we might be able to use this as opposed to just sort of going off of anything. And I always think that that starts with understanding where the swing in this case began. So I'm going to pull this profile off for just a minute. Actually, let's just pull it back to where our trade was filled. Oops, let me get this out of live mode, and we'll just pull this back to where our trade was actually filled. That'll give us a point of reference. Now, looking at this chart, I can see obviously where the bottom of this swing came in, but at the time that we were there, without looking at anything else, I don't know that there's really any sort of reason for me to be looking at this as a point of origin. Right? It's not until we see the market turn and start to move up, and that's always going to be part of trading a swing. So we need to establish some basic rules for when we can start looking at a swing as a potential swing, as opposed to just maybe a pullback or a continuation. So there are a few things that we can look at, and I always like to start with the point of origin, or the lowest point in this case of the swing. If I go back and I look at what traded earlier, I can see that we had another low right here around 7 a.m. Now the best thing for me to do is to use a decision point profile, so I'm just going to pop one on there. and grab the transition at that low. And by transition, I mean this is where the sellers are driving lower. The sellers come in and try and make another push down. They're unable to make a continuation. The market probes down but then rotates back up. We create a new period through the probe and rotation process. We push back up. We push into the last selling effort. And then the buyers initiate enough trade to drive through that selling effort. So this is the transition from the market moving down now into the market moving up. Some of them will be very clear and other ones won't. This particular one is very clear. And when we grab a profile of the two periods, we can see that the clusters of volume are overlapping. So that's generally going to give us a very well-defined normal distribution of volume. And in this case, we can see it right here. This is our support area, should we come back to it. This transition is creating a level of support. We always hear things like support becomes resistance or resistance becomes support. But that's just sort of a little saying, right? It's almost a joke if you don't understand why. And in this case, we can see where the volume was. We can see what happened. And if we're watching it in real time and we're watching that low develop, it's not just some bar on a chart, right? We can actually see the market ticking up and ticking down and ticking up and ticking down and accumulating volume until the sellers try and make a push and initiate enough trade to drive the market lower. That's when the buyer comes in and rejects that and rotates the market back up. We don't see this big period in real time, right? All we see is a fight that's going on right here where the seller drove prior. Eventually, the buyer punches through that and drives back up. And where does he drive back up to? Well, the last place that there was a seller, right? So there's very little volume on the way back up compared to what happened here. That transition of seller hoping that the market drives lower, buyer forcing the market higher, and eventually those sellers have to unwind those positions, right? Not every trade is because you want to take a trade. Sometimes you're getting forced out of the market. You have to throw in the towel. And when we have sellers stuck at a low and the market goes against them, eventually those sellers are going to have to buy out of their positions, which of course creates the momentum that then drives the market back up. So when we look at this as a point of origin, does it make sense that the market's going to hold here? That it could hold here? Obviously not every transition is going to hold. But if you get a low that comes in, and it comes in at a key transition on the chart, that's a pretty good sign that we might have the beginning of a new swing. So what I'm going to do is draw a little line here. And I'm going to draw this from the point of control because that's generally what I'm looking at. But it could come as a range. In this case, we have a range of support that came in here from the edge of value down to the other edge of value. So anything that stops anywhere near the value area as a transition is something that maybe we ought to be looking at as a logical place for the market to turn around. So that's always going to be a good starting point, is where is the low or the high that you're trying to build this off of? Is there any reference point nearby that tells you that that could or maybe should hold as a new transition in the market? The other thing that we want to look at is the action that comes off of that. So if we look at how the market traded into this, it's the same as it was back here. We have sellers driving the market lower. And you can imagine in real time, there was a cluster of trade here where the seller was trying to, again, drive back through, but was unable to complete that transition or that move through. And instead, the buyers lift the market up and we rotate and we get above that low volume. Well, once again, we have sellers that are stuck here. Right? We have sellers that are upside down as the market begins to lift. And rather than seeing the market just tear off like it did here, this one has something very interesting. We lift up and the sellers make another effort to trade down through. Right? This isn't just one shot. They come back and they try again. And what happens? The buyers lift back up, the sellers come in another time. This is the third probe down trying to get through the low. And on the third one down, what happens? The buyers come back in, lift up, trade back up through the last selling effort. The sellers try to come down and drive through it again. And what happens? We transition and lift back up. The buyers initiate trade and carry it away. Now we had several more moves that sort of follow that, but this is the most important one. This is the sign of a stronger low. It's not just a move down that then transitions back up. We create the transition, then we retest the transition, and then we lift. So this, almost every trade that we're going to look at that involves a swing is going to start by having a low or a high, which is then retested and lifts back up. Once that happens, we've got a lot more confidence in it. So at a point back here, we could already be looking at this as a transition low. Now, it's not a perfect transition low because really we're just imagine that all you can see is this. How do we know that the market's now in an upswing? Well, we really don't, but this is the first step of seeing that. We see the low come in, we see it tested, and then we see it break and move higher. So that's one piece of it. We've identified the low, it makes sense why we could be holding there, and we've double tested it, right? Now the other thing that we can do is use the prior swing as guidance, right? Because if we're looking for a swing to hold, then obviously the volume weighted average price shouldn't be broken. So we can go and grab our swing profile and look at what happens on the way down. Here's our swing lower. Here is the volume weighted average price way up here, so we clearly haven't traded through it yet. So it would be difficult for us to, based on the prior action, say, yeah, we're in an upswing. But the pieces are starting to come together, and this should be our first hint as a move away, a retest, and then lifting back up. So once we see the swing take out the volume weighted average price, this is where we've tapped it, and you can see just as we would expect, the market holds, moves away. So it's really not until here that we start trading through it, but notice there are no volume clusters above it either. So we've breached the volume weighted average price, but we really haven't started trading any sort of volume above it until we get here. This is where we start to fully recognize that we've transitioned from a move lower into a swing higher. This is where we could confirm the swing and begin to start tracking it as an upswing rather than a prior downswing. So in this event, we could have actually started tracking this much earlier. We can track it as low as here, and this would have been a very, very small stop. Now, there's a couple of reasons why, still on the chart, this is not set up as a very good swing opportunity yet. Even though we've broken the downswing, right? If we're looking at it in full context, we're not in some major upswing, we're just in a range. So whenever we're in a range, we have to be very cautious of prior transitions, right? If all we were going to do is trade to the other side of this range, well, we can very easily figure out where that would be by putting another decision point profile and finding a transition just like we did at the low. In this case, we can see where the transition from buyer to seller came in, and we could do exactly what we did here. Let's put on a little line and draw this out. This is where we would expect the market to trade to, which is going to be very helpful to you when you start looking for logical targets rather than just well, it's a multiple. This is 2 to 1, this is 3 to 1, this is 5 to 1, or whatever numbers you want to come up with. Obviously, we want our trades to be a multiple of what we're risking, but we also want them to make sense. And so knowing that this is the top of the range as opposed to how we were looking at it when we were trading it, like this, is much more important. But within a range, very rarely are we just going to have one key transition at each edge. In this case, if we think about what took place, we had the market trade up from the low and transition, trading back down and creating some support here. We trade back to here, we lift up, we trade back to here, we lift up, we trade through, and then that's where we have the transition. Well, think about what happened on the way down. On the way down, where did we trade to? Well, we traded down to the same set of decision points. So let's get another decision point profile here so we can sort of reference it. And you can see that that's exactly what happened. Right? We came in and traded down to the prior decision point. The market held, lifted back up, tried to regain momentum. The sellers tried to trade through it. The buyers rejected that and pushed back up. Where did they push back up to? The last selling effort here, where the sellers came back in and drove down again, couldn't get through, rotated, traded back up. Right? So sort of like what happened here, just in fewer periods, we came back to another transition and pushed all the way through it. So we can see that there is significance in the volume that occurred as we came down into this low. So this is a key transition that's in the middle of a range. It's not at a high or at a low. This is falling at another critical decision point that we need to be able to identify. Right? And that's what's so great about probe and rotation charting as opposed to time-based charting or volume-based charting, is that you can see the actual movement in the market and the volume associated with each directional move. So we have a directional move down, we have a directional move down, we have a directional move up, we have a directional move down, we have another one down. And by looking at it in that perspective, the volume associated with each period starts to make a lot of sense. So now we need to think about, now that we've solidified this as a potential uptrend, why? Because it starts at a key transition, it has a retest of the new transition, and an expansion off of it. It's also broken the volume weighted average price from the last swing down. So this is worth looking at, but we have to look at where the market just stopped, just as we did here. Does it make sense that this could hold as a new high for the market to continue lower? And it certainly does. Why? Because we were unable to trade through the exact same transition that we were unable to trade through prior. So here is our transition, here's the effort, the failure to get through, and eventually where the sellers initiate enough trade. Let's put another little decision point on here and just compare. Well, now we have trade which has been unable to penetrate a key transition. So at this point, it's very difficult for us to look at this as a strong, long opportunity. Now, there are other circumstances around it that may make it very valid. Let's zoom in on this a little bit. Look how small my stop is here. It's only a couple of ticks. And if I know that I really only need to get a 2-to-1 return to be satisfied with taking risk off of the table, then I could look at this and say, well, where would I have to trade back up to? Well, let's get our little risk to reward tool on here. We would be looking to go long here with a stop here. That means that basically all we have to do is trade back up and retest this transition. Now, it would be much better if all we had to do was get it somewhere around here, right? If we didn't have to risk quite so much to do it, that would be significantly better. But unfortunately, in order to get that 2-to-1, we're going to have to trade all the way back up to this cluster. So these are the type of scenarios that we're going to be working through. Does it make sense? Are we going to be able to at least capture some easy risk to reward off of this? Those are the types of scenarios that we'll be working through. But based on where this stopped, I didn't see value in putting my money at risk. Right? It doesn't make sense for me to be risking it yet, because in the larger context, all we've done is stop at a key transition in the middle of the range. Now, as we move forward, here we now have volume breaching the key transition. We have a volume cluster on the other side of it, indicating that the buyers have now initiated enough trade to trade through the prior transition. We should be heading higher. Now I can start moving forward with my trend-based trade or my swing trade, and this is exactly where we started placing the trade. Right? We're looking at it as an opportunity to now trade up to the high, right? And to get a 2-to-1 return inside of that high should be very, very easy. We've looked at where the market has now stopped. I'm looking across. I don't see a major transition here. It doesn't look like there was a major effort to try and trade through. All of the effort was down below that here at the key transition. So looking at this as a potential long opportunity now off of the swing makes a lot more sense. Here's where we are picked up. Right? We know that we have to get up here, or that we should be trading all the way across, but We can also look at the risk to reward of the entry here, and does it make sense? Can we logically get somewhere near 2 to 1 out of the trade if all we do is trade back up to this place where the buyers were unable to trade through the last time? We put our risk to reward ruler on. We go long, we have a stop. All we have to do is trade basically back up to the prior highs, right? So now, by looking at this in the full context of the market, I understand why we stopped down here. I can see the retest of that transition on the low. I can see that we traded up to this prior transition down. It held, but then when we came back to the CWAP, that held as well, and the buyers initiated trade through it. I have a gap between here that I can capture, and if I'm able to get through the top, then I'm going to have that beautiful trade up to a 5 to 1 return. So these are the types of trades we're going to be going through in this training series. We're going to look at a lot of different examples. We'll be looking at the euro, which we have here, and just sort of for you to be able to follow along exactly. When I'm trading the euro, I'm using an 8-3 probe and rotation. And we'll also be looking at the ES, which is probably the easiest market to trade with this strategy. It's very simple. There's good transitions in the ES. It's been trading really well all year, and there's almost perfect trades every day with the ES. Again, they are complex. There's things that we have to look at, like when we've traded through the volume weighted average price. What do we need to be looking at to make sure that the trade is still valid? We'll look at all of those things, and then as we get a little bit more advanced, we'll add in some of the other tools that we were talking about, knowing that when we have a significant imbalance like we do here, that's been traded through, and it's been traded through with a sequence of trades. So we turn back on the sequence alerts, and you can see the sequence that took place here. The buying effort that took place getting through this prior imbalance, why we might be able to use that as our stop as opposed to just leaving the stop at the volume weighted average price, so that we can ensure that we're taking much more risk off of the table as well. So those are the things that we'll be looking at in this series. I hope you enjoy it. I'm going to try to get as many examples into this training as I can. And as I said, some of them will just be trades that completely fail, and some of them will be trades that we don't even want to take. So hopefully each video will be a nice short snippet of just the trade logic.